SG Hiscock and Company is a boutique fund manager. We specialise in Australian equities and real estate investment trusts. We were founded in 2001 with 6 principals. We've evolved from there to manage in excess of $2 billion with around 20 staff. Alignment of interest is something that we recognise as very critical in a funds management operation. So right at the outset of establishing SG Hiscock and Company, the founders themselves and their associates invested in the funds, so the co-investment. On top of that, the company itself, through its balance sheet, invests in the funds. Where we see new ideas, such as seeding new funds, we utilise the company's balance sheet to invest in those funds and get them going. If you like, it's like a chef eating their own cooking. We see that co-investment, and that creates a very strong alignment of interest with our investors. What we do is we invest in real estate investment trusts, A-REITs as we like to call them, listed on the Australian Stock Exchange. The investment objective is really twofold. What we're looking to do is deliver an income yield before fees that's superior to the A-REIT sector, and in terms of capital growth, we're looking to deliver CPI plus 3% over 5-year rolling periods. If we move back to the objective, it's to deliver a superior yield to the sector and capital growth, inflation if you like, plus 3% over time. So what we're looking to do is to deliver a strong sustainable yield underpinned by rent collecting. What that means is we're biased away from those groups, if you like, which are more adventurous in terms of development, construction, funds management, those type of activities, to the ones which are more concentrated towards rent collecting. The other thing about this is we're index agnostic. For any investment, we start from a position of 0. A lot of our peer group look at the index and take deviations, if you like, around the index. We don't do that, we start from 0. The other point about our philosophy is we see property as very localised. Understanding the local market and, importantly, understanding the assets within those markets and the assets that are owned by the REITs themselves. There's a very high prevalence of global investors in this sector, and also index investors as well, passive investors. The global investors, they don't have the site visitation that we have. We get out and, if you like, we kick the tires. We go out there, we see the assets, we have a look at them, we meet the managers, we have that engagement, and we see that that opens a lot of opportunities for active managers. Firstly, we look across the investment universe. So we're looking at A-REITs, as I mentioned earlier, we're looking at infrastructure, we're looking at developers and contractors. From that, we narrow it down to a valuation framework. So we have quantitative and qualitative. The valuation framework is a quantitative component. With that, we rank securities from cheap to expensive. The next part is a qualitative component. So that's our fundamental analysis. That is understanding about the markets, understanding the specific attributes about the REITs themselves. So we're using our years of experience, if you like, to form that view. As I mentioned earlier, importantly, we get out, we see the managers, we're getting out there, again, I'll use the expression, kicking the tires, looking at the assets, understanding what's going on at the local level, in putting together our final framework in making our investment decision on whether to put those securities in the portfolio. Typically, we'll hold about 20 securities in the portfolio. Firstly, with risk, the PDS outlines risks, such as, without going through them all, company risk, market risk, liquidity risk, those type of risks. In terms of how we manage the portfolio and how we look at risk, we look at the investments that we invest in themselves. So what we're looking for is we're looking for good balance sheets. We don't want high gearing. That's a big risk. We don't want payout ratios which aren't sustainable. So what I mean by that is REITs paying distributions, if you like, that are beyond their free cash flow. That's a risk. Valuation itself is a risk. You could have a REIT, an investment opportunity that has all the right attributes in terms of their balance sheet, in terms of sustainable distribution, but if they're too expensive, that's a risk as well. So the valuation framework, these are the, if you like, the real tools that we utilise to manage our risk. There's really 3 principal guidelines. The first is to diversify the portfolio. What I mean by that is to hold no less than 10 individual securities. The second is to, if you like, minimise concentration risk. What I mean by that is having no more than 15% in any individual security. The third is the ability to go to cash, to take the portfolio up to 20% cash. And for an example, we might do that if we found the sector's valuation was very elevated. Firstly, Australians love their property. And what I mean by that typically is residential property, their own home or residential investment properties. Real estate investment trusts are attractive in that they really open up the sphere of property opportunities. What I mean by that is shopping centres, office buildings, industrial warehouses, residential development, for example. The other thing about real estate investment trust is the transaction costs. When you go out and buy a property, the transaction costs in your own right are very high. Stamp duty, selling costs, engaging an agent. With a real estate investment trust, transaction costs are very minimal. The other thing is, from time to time, real estate investment trusts may in fact be cheaper than direct property. Something to look for example, is if the real estate investment trusts are buying back their own securities. That would suggest that they may be trading at a discount to the direct property market at that time. The last thing, and very importantly, is real estate investment trusts deliver a good running yield for investors, income, and the prospects for capital growth.